The value of the British pound against the US dollar is at a turning point as we look towards 2026. The currency is facing several major challenges, specifically different speeds of economic growth and central bank policies all across the globe, that is threatening to weaken the pound. The central bank policies all over the globe are moving apart. The similarity between global central banks is ending. The US Federal Reserve can keep interest rates higher for longer because the US economy and job market remain strong. In contrast, the Bank of England is stuck dealing with a stagnant economy. To prevent a worse recession, the Bank of England will be forced to cut interest rates quickly. This difference will lower the returns on the holding pounds compared to dollars, causing investors to move their money away to the US. Now, the UK's government financial situation is also shaky. Facing a large budget gap, the government plans to increase taxes on employers. This risks slowing down the business investment and wage growth when businesses are already struggling to make a profit. These higher costs act as a drag on the economy. This weakness discourages foreign investment, which the UK relies on to balance its books, leaving the currency vulnerable to a drop in the demand. Now, the third factor being the return of the protective trade policies in the US is a serious risk. The proposed reciprocal tariffs, matching taxes on the imports, threaten the UK's trade-dependent economy. Unlike the US, which has a large and diverse industrial base to handle these trade barriers, the UK does not have enough domestic demand to absorb the shock. The special relationship between the two nations offers limited economic protection, leaving key British exports exposed to these new costs. Now, lastly, coming to the technical analysis and the recommendation, a significant bearish structure is confirmed by the 40-day EMA crossing below the 80-day EMA, while the price action in GBP INR remains confined within a 100-day linear regression channel. Given this controlled selling pressure, importers should look to accumulate only if the support at this channel base holds, pausing if it breaks to wait for stability. Conversely, the exporters, having missed the optimal hedging window at recent highs, should now focus on managing downside risk towards the 117 target level. A bearish outlook that aligns with the sentiments is seen in the GBP INR pair. That's all for this video. Thank you for watching.